High mortgage rates are going to crash the US housing market. And that's not clickbait or fear-mongering. I'm not one to monger fear. I'm the guy who makes the videos attacking the fear-mongering crash bros.
Because most people are completely about to go off a cliff.
Yes, like that guy. But right now, I'm legitimately afraid that high mortgage rates are going to crash the US housing market. And the problem is, homebuyers are still going to get the short end of the stick. Let me show you why. The best leading indicator of where the housing market's headed is mortgage applications. When mortgage applications rise, it means more Americans are taking that first step to buying a home, which means demand growth and price growth. When mortgage applications fall, it means that buyers are dwindling, choking demand, and driving prices down. This is Mortgage News Daily's Purchase Index, which tracks the relative strength of mortgage applications, in light blue, against the average 30-year fixed mortgage rate, in orange. Understanding this graph is crucial to understanding today's housing market. In 2020, when mortgage rates dropped below 3%, the purchase index ballooned to 348, its highest point since the 2005 bubble. Peak FOMO, as the crash bros would say. Though, not really. 2005 was peak FOMO. Back then, even though rates were north of 5%, the index topped out at over 500. Speaking of FOMO, I don't want you to miss out on hitting the like button. If you learned something new, let me know by tapping that thumbs up. It helps our channel grow, and I really appreciate it. The story of 2022 is that mortgage rates more than doubled, from just over 3% to just over 7% in under 12 months. Now, this isn't the highest rates have ever reached, but the speed at which they grew, in other words, how sharply this line goes up, rivals the crazy rate hikes of the early 1980s. And as rates grew, we saw a corresponding collapse in mortgage applications from around 312 in the index to 160. Enter 2023. Mortgage rates retreated early in the year, which saw a small spike in mortgage applications, but since then, the trend is clear. Mortgage rates have been steadily climbing all year, and mortgage applications have been falling all year. Right now, with mortgage rates about to hit 8%, the mortgage application index is at its lowest point in 30 years. But here's what's so fucked up. Even though mortgage applications have been falling all year, home prices grew for most of the year. When home prices peaked this year in July, they were only 1% lower than the all-time pricing peak set in June 2022, according to Redfin. The Case-Shiller Home Price Index, which is a lagging but more widely respected indicator of home prices, shows that July 2023's home prices were higher than June 2022. According to Case-Shiller, 2023's deterioration of mortgage applications still wasn't enough to stop the US housing market from hitting a new all-time high in pricing. How could that have happened? And what's different now? Why am I, an anti-crash bro, home-selling, real estate agent, scum of the earth, why am even I worried about a housing crash? Simple answer. Inventory. Prices stayed afloat for most of 2023 because inventory flatlined. Sure, there were record few buyers, but there were also record few homes for sale. As it turns out, high mortgage rates dissuade both buyers and sellers from entering the housing market. 2023 has been a stalemate. Most potential buyers said, fuck it, I'm not doing this at 7%. But also, most potential sellers said, fuck it, I'm not selling my house just to try to buy another one at 7%. For most of 2023, sellers were on the winning end of the stalemate. There were more buyers that had to buy, even at absurdly high rates, than there were sellers who had to sell. So prices grew. Now, the tables are turning, and you can see it very clearly in the data. Pending sales has been dropping steeply for the last 6 weeks. A sale becomes pending when a home goes under contract to be purchased. The purchase is usually finalized about a month later. So pending sales are a leading indicator of closed sales. When pending sales drop off like this, it means fewer homes are going into contract, and we'll see fewer completed sales next month. And notice that the speed at which pending sales are dropping mirrors last year, the red line. This time last year, rates were climbing fast and prices were tumbling. Contrast 2023 and 2022 with 2021 and 2020, the blue and gray lines. 2021 and 2020 have more gradual roll-offs in pending sales, which is what you'd expect this time of year. But while pending sales have been sharply declining, new listings have recently been growing, unusual for this time of year. And active listings have been growing since April. These metrics tell us that more homes are coming to market and staying on the market. In other words, the tide is turning from sellers winning this stalemate to buyers now achieving the upper hand. We see that months' supply has been growing since prices peaked in July. More months of supply means more inventory relative to demand, which means more downward pressure on prices. For that reason, the percentage of listings with a price drop has been growing since May. We're near last year's peak, and I think we're going to see a lot more price drops this winter as, inexplicably, the median asking price has shot up in the last month. I mean, did sellers not get the memo? Market momentum is not in their favor right now. Buyers have the upper hand this winter. Of course, in the raging war that is the US housing market, this winter's win for buyers will probably be a Pyrrhic victory. That's when you win a battle but suffer so much loss that you end up losing the war. Let me show you why. This chart, the average homebuyer mortgage payment, is the defining metric of the post-pandemic housing market. In 2020 and 2021, when rates were rock bottom, home prices grew immensely, but mortgage payments stayed relatively flat. Heading into 2022, the average mortgage payment was still under $1,750. Then rates exploded, and mortgage payments exploded with them, all the way up to $2,400 a month. The rest of 2022 was a game of tug and war between pricing and rates. Back then, I identified a mortgage payment band with a support level at $2,200 and a resistance level at $2,500. But as I called it earlier this year, $2,500 then became the new support level. We spent most of 2023 in a narrow band hovering around $2,600. And in the last month, even as pending sales plummeted and new listings rose, we broke out to a new record high average mortgage payment north of $2,700. So here's what's going to happen this winter. Prices are going to collapse. Prices always fall in the winter. You can see in this graph of median sale prices how cyclical the housing market is on an annual basis. The pandemic threw the annual cycle out of whack in 2020, 2021, and 2022, but it looks like we're back to a traditional annual cycle in 2023. But this winter's price declines won't be typical. It looks like, as J Money says, rates are going to stay higher longer, which means mortgage rates are going to stay higher longer. And I really doubt that Americans can continue to afford $2,700 a month on their mortgage payments. So with rates at 8%, home prices have to fall. But here's where buyers still get the raw end of the deal. I don't see this average mortgage payment falling much below $2,500 a month. We stayed well above $2,500 a month all year. And the demographic reality of our housing market isn't changing anytime soon. Millennials, the largest generation alive, collectively own 18.2 million homes, and they want more. They're mostly in their 30s, starting families, and settling down. Boomers, the second largest generation, currently own 30 million homes, and they're simply not yet old enough to be aging out of home ownership in meaningful numbers. So expect prices to crater this winter. It'll be a mini crash, but just under the surface, the stalemate will continue, and I think we'll snap right out of this cold winter as quickly as it sprung up just as soon as we see rates that start with a 6 sometime next year. So expect prices to crater this winter. It'll be a mini crash, but just under the surface, the stalemate will continue, and I think we'll snap right out of this cold winter as quickly as it sprung up just as soon as we see rates that start with a 6 sometime next year. Subscribe for more rational real estate analysis videos like this one.